Hello friends, Namaskar. Welcome all of you to my channel. Today let's discuss about the beta analysis and the capital asset pricing model. From the equity investment point of view, asset pricing point of view, this is very important model friends. That's the capital asset pricing model, and beta is the one of the important component of this model. Today discussion would be more important from the investor point of view, and even though you are preparing for the exam, you try to understand about the or how we could find the cost of equity capital and because of your investment in the equity market, right? So I believe that today's discussion would be important for all of you friends. Now let's move to the its introductions. That's pricing of the assets seem to be complex in capital market, which is just reverse to the commodity market, in which prices are determined by the interaction of the demand and supply through price mechanism. The capital asset pricing model was developed by William Sharpe in 1964, Lintor 1965, and the Moss in 1966. And as for this model, particularly you need to understand here that is the ERI, expected required rate of return on I stock, is equals to risk-free rate of return plus ERM minus RF. ERM is the expected market return. For example, in our case, like your NEPSE return, that's the index return is called ERM. Okay, like in case of India, in case of let's say the other stock exchange, the whatever the index return is, that is called ERM, and RF is the simply from the NRB, like in our case Nepal Trust Bank data. In case of India, RBI. So is a treasury bill, we see that return, that's RF. So that's the difference between ERM minus RF is known as risk premium, and once you multiply with the beta, which is the measure of market risks, friends. And market risks means simply you need to understand here from the investor point of view, this risks could be categorized into like a systematic risks, and we see that unique risks. Okay, systematic risks, market risks, which is measured by the beta value. Higher the beta value, higher would be the risks, and which cannot be even diversified through the portfolio management. That is the basic part of market risk, friends. And even in 1970, Pharma defined the market as a informationally efficient in his book entitled Efficient Capital Market, a review of theory and the efficient empirical work. In coming days, I will be discussing in detail the pharma study in the area of market efficiency. But anyway, that is the basic. You could connect this concept to the capital asset pricing model too, and that is in an efficient market, the market price of the stock is supposed to be reflect in their fundamental value. That means here the fundamental value means that is simply present value of expected cash flow of the period discounted by the required rate of return on equity is known as fundamental value. Okay, you can say that is the intrinsic value of the stock. So here KE is the cost of equity capital. Here by using the even the capital asset pricing model, you could find the cost of equity capital. Okay, now let's move to the dividend discount model, DDM. That's a capital asset pricing model once again. So intrinsic value of the stock, friends, you might recall that's in stock valuation. The intrinsic value of the stock is noted by P0. It's simply expected dividend, D1 divided by cost of equity capital minus G. G is the growth rate of dividend. Actually, this model was suggested by Gordon. So it's also known as Gordon growth model, developed in 1960. And remember, friends, that's the overvalued stock means what? If the market price of a stock is greater than intrinsic value of the stock, then that is the case of overvalued stock. And then in basically we say that a rational investor would sell its a stock. That is a short selling strategy. We see that from investment management context. Now what about the in other words, you can say that ERI, that's the name of the stock, is ERI, expected required rate of return, is greater than your return, actual return. We say that, then in that case we say that's overvalued. If we say that undervalued. This is just reverse case. Okay, this is the simply the long position strategy. So that is the point, is that the value of the stock is affected by K, and which is linearly related to the risks. Okay, so capital asset pricing model, the expected return on the stock is found by using the following equation as I discussed earlier. Like if I would say, like you are going to find the expected return, yeah, required rate of return on the TCS, Tata Consultancy Services. So you would be using the same equation here, right? RF plus ERA minus RF. Now beta of TCS, we say that, where RF is that in case of India, I would say that's RF is the government treasury bill rate. That's a repos rate issued by the RBI, and the next one is the that's a ERM. ERM is simply expected return on the market index, like your BSE Sensex 30, right? So simply, friends, beta, that's you could find in Excel. You could find just by simply, but remember, beta is the ratio of covariance of this RTCS RM divided by variance of the M. Now covariance you could find by using this equation, like you might have studied in statistics too, like RTS minus R bar DCS. This is average return. Now RM is the market return minus average market return, whole sum divided by n minus 1. Okay. Now remember, when your covariance is positive, what it means? It shows simply the returns tend to move in the same directions. Okay, that means return of TCS and the BSE Sensex return will move in the same directions. While if this is negative, this is just opposite direction, we say that. And just to support our calculation, sometimes we find the correlation coefficient 2, that will that value lies between plus minus we say that 1. Yeah. And the while variance of the market, that's all about your sum of that's RM minus R bar M square divided by n minus 1, that is the variance. Okay, if you square root is, that is the standard deviation of the market return. Okay, now let me clarify about this figure 2. That's you could see this is our x-axis is the beta value, and in y-axis we have a expected return, right? As I explained earlier, the beta value, higher the beta value means your required rate of return would be higher by using this model. Okay, but beta value could be less than 1, yeah, greater than 1. If this is the case, friends, that is the beta is greater than 1, it means stock or your investment is more volatile than the overall market. If beta is less than 1, it means stock or investment is less volatile than the overall market. But at the same time, when the beta is 1, you could see at beta 1 your market, this is the equilibrium conditions, right? So asset price tends to move in the line with the overall market, we say that. Okay, basically, friends, today we discuss about the context of capital asset pricing model and its components of capital asset pricing model, in practically how we could do the research in the area of like testing capital asset pricing model, and even we could apply the dividend discount model to understand the whether that stock is overvalued or undervalued, and what should be our investment strategy, like that. Okay, friends, these are the things that I would like to share today. If you really like this content, please like, share and subscribe my channel, that is the Finance Guru Pawan Kumarja. Thank you all of you for watching this video. Please take care all of you. Thank you all of you.